In this video, I'm going to talk about market efficiency. So the efficient market hypothesis indicates that assets are correctly priced given current information. Now, there are a couple different levels of the efficient market hypothesis, or EMH. So I'm going to walk through those and kind of what they mean and so forth. So I'll start with weak form efficiency. So for weak form efficiency, asset prices reflect all prior price and volume information. So here's what that means. If you are looking at, say, the stock market and you look at a share of stock, it's pretty easy to pull up a stock price chart. So you can just type in the ticker symbol on any number of finance websites, and you can pull up a chart of the stock price over the past year, 5 years, 10 years, all kinds of different lengths of time. And with a few clicks, you can generally pull up volume information showing how many shares were traded and all kinds of metrics associated with that. And you can do moving averages and all those kinds of things. Weak form efficiency basically says that the stock price already reflects any information that you could glean from prior price and volume movements and information. So basically what that translates to is looking at a stock chart is not going to help you do a better job of investing. You're not going to beat the market by looking at a stock chart, because basically any information you could have derived from past price or volume information is already going to be reflected in the stock price. So what that basically means is technical analysis is pretty much out. It's not going to help you do a better job because basically those stock prices and volume information, those charts are all very readily available. It's very easy to look at it. If you can learn anything from it, people should have learned it already. And then they should have made investment decisions on it. And if they did that, then the prices should already incorporate that information. The next level is semi-strong form efficiency. So this takes things a step further. And it says that asset prices reflect all publicly available information. So not just past price and volume information, but any publicly available information. So if you go to the Securities and Exchange website and you start looking at financial statements for the company, the semi-strong form of efficiency says that information, anything you can learn from those financial statements, is already reflected in the stock price. And the reason for that is, well, it's not that difficult to pull up financial statements. And there are a lot of people who are out there and they can easily access them and they can evaluate them and so forth. And so it kind of makes sense that people would have already acted on that. And therefore, any information that could be gleaned from this would already be gleaned from this. Here's another example. Note that this says asset prices reflect all publicly available information. So here's a question for you. How long does it take a stock, or maybe even the stock market as a whole, to respond to news items? And if you're thinking about it, and you've been paying attention to the stock market, what you'll probably be thinking is not long, right? So if there's some kind of a fire at an oil refinery, or there is war starts breaking out in the Middle East, or the Federal Reserve changes interest rates, or new unemployment data comes out, or pretty much fill in the blank for anything, company specific or economy wide. The stock market or companies, stocks tend to start responding very rapidly to that new information. So there's quite a fair amount of information that tends to suggest that probably that semi-strong form of efficiency really probably does work to a certain extent. A fair amount of support for that. And we observe this on a regular basis. News items come out and the stock price responds very rapidly, right? So basically, if it's publicly available information, probably the stock price already incorporates it. But let's take this a step further and let's talk about the strong form of efficiency. Strong form of efficiency basically argues that asset prices reflect all relevant information, not just publicly available. So that would mean it would also reflect private information. So let me give you an example. Let's suppose you think of a major company and you think of the CEO. And if there is an email that landed in the CEO's inbox saying that they're having problems with their latest product and so forth, the strong form of efficiency says, hey, that's information that's relevant. That's going to be in the stock price too. And if you're thinking, how would that affect the stock price? Nobody even knows about that other than a handful of people at the company. Like how would that be in the stock price? That's a great question. And the answer is there's actually a good reason to believe it probably might not be. However, there are also some arguments that can be made for how it might be in some respects. So let me give you an example. I have no idea what the CEO of a major company has in his email and what has landed in his inbox today about product problems, etc. but I can watch what he says and I can watch what he does, and I can kind of glean, perhaps imperfectly, some information about whether he's sounding more optimistic than normal or more pessimistic than normal, right? So even though I don't know exactly what he's got in his email, I can get maybe a glimmer of an idea of whether he's seeing good things or bad things. So even from that standpoint, there is an argument to be made that some of that information might be leaking out into the stock price and affecting stock prices, because people do pay attention to whether CEOs sound positive or negative. So even though we don't know what the CEO has in his email, it's possible that some of that information is affecting stock prices. Now, the bulk of the studies that have been done really probably have landed on the market probably being somewhere in that semi-strong form of efficiency level. A lot of support basically saying weak form efficiency is really probably pretty supported. Semi-strong, pretty good amount of support for that as well. Strong form, maybe not as much, although there is some reason to believe that some of the information does kind of leak into the stock price, but not as clear for that. Now, let's kind of talk about what that means then. So what that means then is this kind of ties in with something called the random walk hypothesis. And basically, what that means is that short-term stock price movements are going to be essentially random, because over the short term, it's going to have a whole lot to do with what random news items happen to come out. So if there's some kind of news about war breaking out, or a refinery fire, or all of a sudden somebody files a lawsuit alleging that a company's products are unsafe, or whatever, whatever those random things are going to be the things that are going to tend to move the stock price, and it can move it up, it can move it down, who knows. So over the short term, basically what this is saying is the stock prices look extremely random, and that's where the term random walk is coming from. It's actually a statistical term, and basically what it boils down to is over the short run, it's really unpredictable. It just kind of depends on what news hits today. And so if you're looking at what the stock price is going to do over the course of a day, who knows what that's going to look like. That's the idea behind the random walk hypothesis. Now, over the long run, typically, the idea is the stock prices maybe sort of random walk short term, but with what's called kind of a drift. In other words, they may tend to go up in the long run, but again, that's more over the long run. In the short term, it just looks really random. So you just kind of zoom right in and look at a really short window of time. It's like all bets are off about what the stock price is going to do over that very brief window of time. I mean, it just flat out starts depending on who hit the buy button and who hit the sell button today, right? Because that would affect the price, and just depends on who made that decision today. So it can be very random over the short term. So what are the implications of the efficient markets hypothesis? So the implication would be that you would diversify and invest broadly, because basically if asset prices correctly reflect in all the information, then basically what that means is you can't beat the market. You can't find a bargain. You're not going to find the next big thing, because basically if I look at the price for a stock, that price reflects everything that we know about that stock today, as of now, given current economic circumstances and everything else. So basically that price is our best estimate. And so that would basically say, if that's the case, and I can't just find a great deal, I can't find a bargain, it basically says, I'm going to invest in like everything I can. I'm going to diversify. I'm going to invest really broadly, and basically just try to sort of invest in the whole market. And that's kind of the idea. Kind of the saying, if you can't beat them, join them, right? Which, side note, it's kind of a little bit of a weird saying, but in any case, that's kind of the idea. If you can't beat the market, you can't figure out which stocks you're going to do really well. You can't figure out which one's going to do really poorly in advance necessarily. And I just sort of buy everything, and I just benefit from the stock market going up in the long run. Now, there is an area of finance, which is behavioral finance, and that basically suggests that when you start studying investors, you kind of start to reach the conclusion that investors may not always make the economically rational choice. And so that means that maybe prices don't always reflect the information that's available the way they should, because it kind of looks like investors do some strange and irrational things sometimes. So for instance, when investors have been presented with investment opportunities or risk scenarios, if they're told sort of the probabilities of gains, they may make one choice. But if you tell them the probabilities of losses, they may make a different choice, even though technically they could be looking at the same probabilities of gains and losses for the same investment. So in other words, how the question is framed can actually cause investors to make different choices. And so if you look at that, you think, well, from an economic standpoint, if I tell you you've got a 50%, or let's say I tell you you've got a 60% chance of winning in your investment going up, or I tell you you've got a 40% chance of your investment going down, technically those are the same things. Assuming there's no chance of it staying the same. Well, basically the idea here is kind of looks like investors don't treat it that way, right? So if I frame the question as 60% chance of going up, or if I frame it as 40% chance of going down, investors actually make different choices, which kind of shouldn't happen quite that way. So that's kind of the idea. The investors may not always do that. And so from a behavioral finance standpoint, there's a question here of just how efficient is the market? Maybe people aren't quite judging things right. And maybe they overpay for things or underpay for things. That means maybe some stocks are overvalued, meaning they're selling for more than they're really worth. And maybe some stocks are undervalued. Maybe they're worth more than they're selling for, basically because people may have behavioral biases and they may judge things incorrectly in some way. And so that's an interesting challenge there to kind of market efficiency. But most of the studies that have been done tend to land on probably the markets are somewhere in that semi-strong form of efficiency, give or take a little bit. All right. So hopefully this kind of helps you a little bit with the idea behind market efficiency and the efficient markets hypothesis. Thank you so much for watching and have a great day.